You know, we all love being generous with our loved ones, but what if that generosity accidentally came with a massive surprise tax bill from HMRC? Well, it can, and it happens more often than you'd think. So in this explainer, we're going to break down 5 key strategies to gift money completely tax-free, making sure your hard-earned cash stays right where you want it to with your family.
I know it sounds a little dramatic, but could your generosity actually be funding the tax man? For a lot of people, the answer is yes. See, under UK tax law, any big gift you make can still be treated as part of your estate for a full 7 years. And that means a simple, kind gesture could end up padding the final tax bill your family has to deal with.
So what's really going on here? Well, the culprit is something called inheritance tax, or IHT. When those gifts you made are added back into the value of your estate, it can easily push the total over the tax-free limit. And that means one of two things. Either your beneficiaries get less money, or in some cases, the person you gave the gift to could get a nasty surprise bill from HMRC themselves.
Okay, so this is the big question, right? Let's say you slip your niece a few £1,000s in cash to help her buy a car. How on earth would the tax office ever find out? There's no form to fill out at the time, so where does this information even come from? Well, the answer lies in what happens after you're gone. HMRC finds out about these gifts during the probate process. See, the executor of your will isn't just handing out your belongings. They have a legal duty to paint a full financial picture of your last 7 years, and that absolutely includes any gifts you've made. And believe me, this is a serious responsibility. Your executor has to fill out official IHT forms that specifically ask about gifts. They'll go through bank statements and financial records, hunting for any large or unusual transfers. And here's the kicker. The executor is personally on the hook for the accuracy of those forms. It's not something they can just sweep under the rug. But enough of this scary stuff. The good news is the system has some great ways to gift money completely tax-free. You just have to know the rules. So let's dive into our first strategy, using your yearly allowances. First up, we've got the annual exemption. Every single tax year, you can give away a total of £3,000 completely free of inheritance tax. You can give it all to one person, or you can split it between a few people. And here's a fantastic tip. If you don't use your allowance one year, you can carry it forward to the next. That means you could gift up to £6,000 in one go. On top of that £3,000, you also have what's called the small gift exemption. This one lets you give up to £250 to as many different people as you want each year. There's just one crucial rule. You can't give a small gift to someone who's already gotten a slice of your main £3,000 annual exemption.
So, what's a great way to use these allowances?
Well, Sam Richardson from Which Money has a brilliant suggestion for gifting to children. You can use your allowances to pay into a junior ISA. Once a parent sets one up, literally anyone can contribute, and all the money in there grows completely tax-free for the child. It's a fantastic strategy.
All right, moving on from the standard yearly stuff, let's get into our next 2 strategies. There are a couple of really powerful rules for special situations, including one that's so rarely used, it's practically a secret. Our second strategy is all about special occasions. If there's a wedding coming up, the rules get even better. You can give a tax-free cash gift of £5,000 to your child, £2,500 to a grandchild, or £1,000 to anyone else who's getting married. And get this, you can stack this on top of your annual exemption for an even bigger tax-free gift. Okay, let's talk about strategy number 3. And this is the one that most people have never ever heard of. Seriously, this can be a total game changer if you have a regular disposable income and you want to give someone ongoing support. Just look at this number, 430. According to a Freedom of Information request, that's how many people in the entire UK used this exemption in a recent tax year. 430! That is an astonishingly low number, and it just shows you how powerful and under the radar this rule really is. So how does it work? Well, to use this rule, you have to meet 3 crucial conditions. 1, the money has to come from your income, like your pension or salary, not from your savings. 2, the gifts have to form a regular pattern, like paying monthly rent for someone or covering yearly school fees. And 3, making these gifts can't mess with your own standard of living. If you tick those 3 boxes, there is no upper limit on how much you can give away, tax-free.
So what happens if you want to make a gift that's bigger than all these allowances we've just talked about? Well, that's where our 4th big strategy comes in. And this one is all about timing and beating something called the 7-year clock. Any large gift that doesn't fit into one of those neat exemptions is called a potentially exempt transfer, or a PET for short. And the name really gives the game away. It is potentially exempt from tax.
The condition is pretty simple. You have to live for a full 7 years after making the gift. If you do, it becomes completely tax-free. But what if you don't quite make it the full 7 years? That's where a sliding scale called taper relief comes into play. As you can see right here, the potential tax rate drops the longer you live after making the gift. If you pass away within 3 years, the tax is the full 40%. But by the time you get to years 6 to 7, that rate drops all the way down to just 8%, before hitting 0 once you cross that 7-year finish line.
Now, there is one final, absolutely critical detail you need to understand here. These big gifts, these pets, they use up your main £325,000 tax-free allowance first. So think of it this way. A large gift could basically empty your tax-free pot, leaving less available to protect the rest of your estate, like your home and savings, from tax. It's a really important point.
So, we've covered 4 really powerful strategies, but they all depend on our 5th and final point, the one essential step that makes it all work. And this isn't just good advice. This is the component that makes every other strategy you use legally valid. And look, this does not have to be complicated. Just grab a simple notebook or start a spreadsheet. Note down what you gave, what it was worth, and the date you gave it. And here's the most important part. Tell your executors where to find these records. It will make their job and your family's life so much easier.
And this brings us right back to where we started. Remember that legal duty the executor has? By keeping clear records, you're literally handing them the exact information they need to do their job correctly. It's such a simple act, but it can save your family a massive amount of time, stress, and potential tax trouble down the line.
At the end of the day, all of these rules and allowances are really about one thing: empowerment. They give you the control to make sure that your financial legacy actually goes to the people you care about most. So the real question isn't just about what you give, but how you plan for it. Thanks for tuning in.